Good morning, good afternoon, and good evening to everybody, once and all. Yes, we're back. It is the Smoking Barrel back from summer holiday, ready to look at the second half of 2024. I'm Rustin Edwards, based here in Geneva, with my illustrious co host in hot, steamy Dubai, Mr.
Yeah,
Matt Stanley.
morning. Yeah, morning. Yeah, we're back. We didn't intend to be away for a long, but rubbish happened. And what can you do? Life gets in the way. But the smoking barrel is resilient, much like this oil market, and we are back. We got some there's some conferences coming up, which unfortunately I'll be attending, but you won't, Edwards. Our usual APEC soiree won't be happening this year, but you'll be there in spirit, won't you?
I'll be there in spirit. You can hold it. You can hold the candle up and have the memorial service while I'm still gallivanting my way across to the U.S. East Coast for my 30th anniversary for university.
There you go. 30th anniversary. Hey, amazing. What an anniversary. But yeah, you will be there. You'll be there in spirit, and I'll be soaking in spirits. Put it that way.
Oh, there you have it. Or a
Ah,
nice fine cool lager on Boat Key.
yes, exactly. No, but look, 13th of August, 2 weeks until the kids go back to school. No, love them. And yeah, look, summer's drawing to an end. The Paris Olympics is over. Yeah, look, it's
I don't know what to do with myself anymore. I have nothing to watch on TV. The last 2 weeks, that's been some great entertaining sports to watch.
yeah, I put on my commentary this morning that on Saturday I sat behind my sofa like this, watching that stupid Madison bike race that took about an hour, and it's just chaos and people falling over and smashing their. It was just frightful experience. But yeah, the Olympics, the gift that keeps on giving.
Well, I'll tell you, one thing that keeps on giving is this oil market. We're basically well established in the smack-based band. If you look over the last couple of months, between 75 and 85 bucks.
Yeah.
Right, almost smack dab in the middle, 81, 87 right now on front month Brent.
Yeah, closed at
Um,
80, closed at 82.30 yesterday, but decent day yesterday for crude. I mean, look, this time last week, our conversation would have been a lot different. We were trading down on the 6th of August, $75 a barrel, 75.58. We were on the low on the day. But look, I mean, yeah, look, there's lots we're going to talk about, but the tech sell-off, the equity, what happened in equity markets was just
well, that was
let's call it an aberration.
well, it was a reallocation of risk out of yen-based trade assets into other currencies, which caused a massive liquidation of risk-on elements that were basically being used as yen leverage to um, be able to buy or sell certain equities or certain risk elements. And of course, once you have a massive pull off in the stock market, oil follows suits along with every other commodity for the most part. But then the bounce happens and up we go. I mean, if anything, it became a buying opportunity for a lot of traders to come in. If you
Yeah.
look at what happened with crude structure, it collapsed and then it rallied right back up again. So if you closed your eyes 2 weeks ago, open your eyes today, you'd say nothing's changed in this market. It's about the same.
Nice. Yeah, exactly. I mean, I'm just looking at, WTI structure, which is like $1.70 backward in the front. I mean, that's very high. That's steep backwardation. And it's $1.10 for OCNOV, and then it's 84 Novi Deck. It's still significant, even out to N24. Brent, not quite so steep, but still doing well. 90 cents OCNOV at the moment. OC Deck trading $1.56. I'm becoming wistful here, Edwards, talking about all these trading markets, but that's a time that I left behind last 2 years ago. Yeah, look, I mean, $1.70 for front TI structure, that seems a bit excessive. That seems a bit toppy to me.
Well, it does seem a bit toppy. I mean, because I mean, you got to think this time of year you're rolling into. You probably have a bit of weather premium on top of this, causing this move up because everybody's expecting a massively strong hurricane season. We're
Yeah.
one third of the way through. We now have our fifth named storm, which puts us on path at the current rate of maybe 7 to 9 storms this year, when all the predictions are for 2017 to 22.
Yeah.
So you probably still have a bit of a weather premium because we are getting into the hotter side of the hurricane season. Usually October or September is where you see the massive explosion in weather pattern, but it
Yeah.
hasn't materialized yet, despite the early lifting we had on weather in July. So you probably have a bit of that in there, but then U.S. production is up 13.4 million barrels. So that's actually fairly bearish. And you've got refineries talking about cutting runs because the margins aren't there in the United States. Marathon, Valero, both came out with announcements they're going to be reducing run rates. PBH as well, which are
Yeah.
which is about 40% of your U.S. refining capacity. That's looking to cut runs. So, nevertheless, having that steep a backwardation doesn't quite make much sense.
No, right. I mean, you touched on, obviously deep within, seasonality with weather patterns, hurricanes, but also is this steep backwardation as sort of the fallout after the wildfires in Canada, which are again seasonal? Is that largely that's fizzled out? That risk premium that was sort of priced in about, like you said, the hurricane season being so active this year, which hasn't materialized yet, still a bit early. But the wildfires, I'm just wondering if people are still scrambling around for cargoes, and that's why backwardation is so steep in the front.
Is it a combination of the wildfires plus also the TMX pipeline? Because remember that has kicked off. That's supposedly running at almost full rate.
Yeah,
As you are taking barrels that could be going south, going to the west coast of the west coast of Canada for
yeah,
export.
yeah,
So maybe it's a combination of those two, but nevertheless, it's preventing a very just hyper backwardation in the front.
yeah. Yeah, that's an interesting one. I mean, just sticking within US, you touched on what, 13.4 million barrels a day US production. I don't know if you heard his Donaldness on he's back in on Twitter. The real Donald Trump is back on X. So expect some I don't know, Tourettic headlines coming out about Kamala Harris probably. But he was being interviewed by Elon Musk this morning, which was interesting, which was delayed by 40 minutes because there was an apparent cyber attack. I mean, I don't know why I'm laughing. I don't know why that's funny, but it can't. I just find it extraordinary that Elon Musk and Donald Trump, arguably the two most watched figures on politics and business right now, that they're in that position. But the one thing that Trump mentioned to Elon Musk this morning was, that energy prices in the States are still too high. He wants to drill, baby, drill. He wants, his energy policy clearly is going to be supportive for big oil, but he wants the price or the cost of heating or cooling down the home for the end user in the States to be reduced dramatically. Is that Trump as it was 5 years ago when he was writing his tweets to OPEC and all that? I mean, it seems like it's going to be same if he gets back in November.
It probably will be because I think the one thing that people forget to realize that a majority of the home heating is done by nat gas or LPG in the United States, not by diesel. Diesel is primarily a U.S. East Coast, Northeast phenomenon when it comes to home heating oil.
Yeah,
But nevertheless, it's a large boost to population. But nat gas is cheap as chips in the U.S. So, and that's actually impacting, I think, the earnings of a lot of the oil drillers, especially as crude flat price gets lower. The fact that you're still producing a lot of associated gases that come out of a lot of the fracked wells, and that's getting depressed as well. It puts you into a condition where you can't really do much more than cut drilling to support your returns if you're a driller, which impacts then all the supply down the road and keeps prices a bit elevated. Now, U.S. gasoline prices and distillate prices, it's a global economy. U.S. is a major exporter of products, and that's the reason why prices have to come home, have to match up to what the export parity price is, therefore, to keep the barrels home, to keep supply in place. But there was a big but. Demand for on-road diesel, on-road gasoline has not materialized at all what everybody was expecting this summer so far.
Well, I'm not sure everyone expected it quite to be quite as good. I think there is one group of ministers who get together monthly and talk about oil.
I mean, the smoking barrel.
They're not invited yet. We'll let them know. The invite's in the post. Sorry. No, OPEC, obviously, yesterday. Nice segue, Edwards. Nice. Downgrading their oil demand forecast for 2024. I mean, look, it's
And
nearly
2025.
two-thirds. Huh?
And 2025. They did it for both.
Yeah, okay. But I mean, there's still over 2 million barrels a day. I mean, let's call, well, I was on the radio talking about this morning in a local radio station here. Let's call the OPEC demand forecast enthusiastic. Okay, let's be polite and let's call it enthusiastic.
Not Pollyannic. Not
Well,
Pollyannic.
well, Napoleonic. No, it's a difficult one, isn't it? Because they have skin in the game. They have a barrel in the game. They have lots in the game. They need prices. They will be bullish for the thing that they are controlling the supply of, which is oil. But look, I mean, reality had to bite. It had to hit. I mean, the fact that they only reduced the 2024 oil demand forecast by 140,000 barrels a day, I think means that they're putting all their OPEC oily eggs in Q4. I mean, China has got to increase oil demand, but I think Clyde, our good mate Clyde Russell, wrote a really good piece this morning. I think he said that something like OPEC expects Chinese oil demand will rise by 700,000 barrels a day in 2024, which means that the world's largest crude importer will account for 1/3 of the global increase.
Yes.
And they only downgraded by 140. The problem is, okay, here's the thing. Let's not get bogged down in trying to establish how poor OPEC apparently are in terms of the forecast demand. If they had come out and said, all right, we got it wrong. We think actually we're going to revise our demand forecast down by 500,000 barrels a day. What would the market reaction be on flat price?
Well, the market reaction of flat price would be an immediate negative reaction. It would sell off. However, it would then open to a fairly significant rally because the narrative would be, well, that means OPEC's got to actually cut production.
Right.
And so I think you see initial reaction sell off, and then OPEC, scary headlines that OPEC will have to cut 1 million barrels more and not release any of the voluntary cut as originally planned, which will then change all the demand dynamics and the supply dynamics for projections. And people will all of a sudden start predicting massive stock draws across the globe, and prices will probably rally up to 85, 90 bucks.
Yeah, you know
It's
what?
probably,
It's go on.
it said it's probably in their interest to say that they got it wrong, because the market reaction will be, oh my God, that means they're going to have to cut more, or they won't release. Because if they don't increase their production, then you end up with stock draws based on current analytical results of looking at Chinese demand and Asian demand. You end up with stock draws, assuming that China is there to pull that oil.
Yeah, I mean, look, if you're OPEC, though, this is where I sympathise, because what you probably you've got these big teams. People think that they kind of make this decision on a bit of a whim. Oh, oil prices are doing okay, and there is, I'd imagine, myriad calculations they go through, and what they probably do is sit down and go, okay, here's 3 scenarios, right? Here's our demand forecast. It hasn't rung in. Let's reduce our demand forecast via our monthly report by 500,000, 300, or 150, right? And then they probably then will talk about, what do you think the market reaction will be with each of these 3 scenarios? It's not just what they do, it's managing market expectations and reactions of what they say, even if what they say doesn't make that much sense, right? And what I mean sense in a polite term, they know oil demand hasn't come in anywhere near well, not anywhere near, but nowhere near as optimistic as they initially forecast. They have to be optimistic, so they're always going to be on the upper end and the higher side. They follow what Saudi do. Saudi are again on the upper side of where oil demand growth is going to be and finish this year. But if they do tell the truth, the market doesn't like it. You don't like the truth. What was that film? Few Good Men. That's what they probably like a few good men. Jack Nicholson in the corner shouting at them, you don't like the truth. No, but it's very much, okay, I think OPEC are aware what the reality is when it comes to oil demand, but they have to cushion the blow, right? That's essentially what they're doing.
Well, I don't know about cushioning the blow, but I think they have to talk their book. It's one thing if you're the IEA, where you don't really have an underlying production that you have to protect, or the EIA, where okay, you are the United States government, but all your production sits in the hands of private entities and private citizens, public companies as well.
Yeah.
So again, you don't really control that lever of production, so you can make a unbiased prediction. But when you're actually a guy, as you said, with skin in the game, like OPEC is and OPEC Plus is, yeah, you are more intended to say, "Oh my God, demand is so great. Oh my God, look at this," and not try to be too bearish because again, it's going to impact your bottom line at the end of the day.
Yeah.
And from all analytical results I've seen, I've been using that word analytical a lot today. Russia and Saudi Arabia are $10 below where they need to be in order to make their budget break even, whatever that means, because your budget can be whatever you want it to be. But nevertheless, that's the problem they have is that how do you keep markets supported and still keep a brave face, stiff upper lip in the face of waning supply and demand that's coming out of Asia?
Look, us British are good at that, stiff upper lip. Let me share my screen because I've got a couple of things I want to show you. But yeah, look, I think that's that was my main takeaway from yesterday. Overall is that people looked at it and thought, okay, that's quite significant that OPEC, are adjusting their oil demand forecast down. They haven't done that for a while. But there's, like I said, China's imports and okay, oil demand growth isn't just about oil imports. It's about stock drawdowns and all that kind of nonsense. The metrics are a lot deeper than just, the number of barrels that people are buying or importing. But if you just focus the optics on oil imports, China are picking up all the slack. That's what OPEC are effectively saying. And then for OPEC to blame China, and we're going to touch on that in a minute because there's a couple of articles we want to talk about there. I think that there will be some further downgrades to the old demand forecast coming in later on in the year, don't you?
Well, I think they have to get to some basis of reality on where oil demand really sits. But again, I think that's going to drive the decision of what do they do with their next OPEC meeting, in which I think they're going to defer the cuts. They're going to defer I'm sorry, not defer cuts. They're going to defer the bringing oil back to the market, and then they're going
Yeah.
to push it down the curve. So, the expectation that they're going to start bringing supply back in October may not actually materialize.
Yeah, I think that's what a lot of people are thinking about now. I mean, and I'd argue that's probably why prices rallied so much yesterday. But I just want to touch on this. Something my colleague Esteban wrote actually on the 4th of July, your favorite day of the year, Edwards, which is over a month now since we wrote this. This puts into context, where how do Kepler's demand forecast way up against the other agencies, the big agencies being obviously International Energy Agency, Information Administration, Kepler, and then OPEC. And you can see here, this is 2024, so just over 2.2 million barrels a day of demand growth. That's what OPEC were forecasting. That's been reduced yesterday. Obviously, this is an old chart to down about here. Now, largely, we are in line with the other agencies. Where has it actually come in? This is up to April, about 1.5 million barrels a day. That is probably down towards here now. And we actually need to, we're revising our forecasts accordingly. Next year, however, is a different story. I mean, let's say pessimistic for next year in terms of where we see oil demand growth for 2025. OPEC see it just over 1.8. We see it below 500,000 barrels a day of demand growth. Now, there's a lot to pick at there. But essentially, I want to talk about China, Edwards, because we can't not have a podcast without talking about China. And this is a paragraph that Esteban wrote. This here. Additionally, it is our view that China, which has been the largest contributor to diesel demand growth over the last decade, representing nearly a third of all growth. Now that first sort of sentence, that is clearly what OPEC are extrapolating in order to see to come up with their number about why they see China being so important in oil demand, in the growth in oil demand. But we see it's approaching the end of its demand growth boom. Weakness in the property market is expected to constrain growth, while the increased adoption of cleaner engine alternatives such as LNG and CNG and a potential transition of its economic model away from industrial production and exports will further dampen demand in the mid to longer term. Brutal. But look, I mean, you know, we've got a colleague, Elif, she's our long-term energy analyst. She's great. These are the realities that OPEC need to face themselves with. We've banged the drum for the last, so since we set up the podcast a couple of years ago now, blimey, complacency regarding growth in China is something the market is dangerously still pricing in. And I think that, I wouldn't say that time has passed, but that chapter is coming to an end. Don't you agree?
Oh, I fully agree. I mean, if you look at the changes that have happened, the structural changes that have happened in the Chinese economy over the last year, even the last 18 months, has been a rapid adoption and implementation of a green energy policy, reducing emissions, reducing consumption of coal, the massive adoption of EVs when it comes to not only on-road cars but also for trucks and freight transportation is all being underestimated by a lot of Western analysts. I think that's a pit that's going to come back and bite a lot of traders in the butt coming forward because they're overestimating the demand in China for petroleum products. Now, the consumption of consumer fuels is one thing. To run your refineries at a high rate just because it creates GDP and helps the central government meet their GDP targets is probably the strategy that starts to happen. And so what you're starting to see is China's filling up their tanks internally of products, granting more export quota to export those excess fuels that they don't need internally to the market. And that is probably the shift that's going to be happening. So you could still see good Chinese demand for crude, but China might be exporting more product out to the market than people realize because they don't have the demand for the product internally. I mean, I think there was a good chart I was looking at on the World Economic Forum where they're expecting to see 2 to 3 million barrels of demand destruction for on-road fuels going into 2025 due to EV pickup across the globe. And that's just not only cars, but it's also the EV bike, the EV scooter, the truck, and the cars. And you throw on top of that efficiency gains, you're probably seeing 3 to 4 million barrels of demand destruction going into 2025, which I don't think a lot of people take that into consideration.
No, look, I think you made a really good point there. And look, this isn't doom and gloom, people. All right, this is just reality. It's not all demand will continue to rise. It just won't rise as exponentially as many people think, and it's going to taper off. We know that. That's not like breaking news. But the reality has to.
Honey eating bear likes to say we're in peak oil demand today, and you know it may go up, it may go down, but we're at the plateau. We're at the top of the demand profile.
Yeah, I agree. But I think what you've said there, right, and this is something that's really important. People think that China are just this dinosaur in the energy space, just consuming coal because they've got this exponential growth and they don't care what but they're leading the way. They're leading the way in electric vehicle manufacturing that's more affordable. They're leading the way in terms of renewable energy. They produce 4.5 million barrels a day of their own crude oil, which people go, what? China has crude? That's okay. They are doing it very, very slowly. Just because they're not out there with Greta Thunberg slapped all over their T-shirt saying, no more oil or just stop oil bollocks, doesn't mean that they're not doing it. They absolutely are. And to your point, I think the market is starting to acknowledge that. My colleague Elif wrote this really good piece on last week. China's gas oil demand is set to peak in 2026. I read that and I had to reread it because it came out last week and I was like, shit, are we saying here that this, to me, this is like a sort of, an icebreaker. This is the first time that we see, and you can see here, we got a chart out until 2040. You can see this, right? Properly?
Yep.
Yeah. So you can see here, 2026, we see, what's this, 4.5 million barrels a day of China, of gas oil demand by sector in China. And you can see that tapering off to drop down to just above 3 million barrels a day by 2040. That is significant. And you've got, okay, this is what's going to happen. There are reasons why. We'll touch on those reasons in a minute. But that is a really important moment for the oil market to acknowledge. China and its biggest industrial use fuel being diesel, tapering off. It's only 15 months away, 16 months away, 2026. It is happening. We actually see Chinese gas oil demand dropping off by, say, 30% in the next, 16 years, 2040. That is significant. That oil has to go somewhere. China are only building more refineries. It's not like they're closing them down. They're building more. The Yulong refinery, this massive new one, goes online, if not now, very, very soon. That material has to go somewhere. China are not going to buy it, so it has to be bought by someone else. That is when you start getting into the down cycle when it comes to oil products. And, reach out if you want to see more on this. It really goes into a lot of detail here. But look, the chart don't lie, man. The chart don't lie. I mean, what's your view on this?
We've been stating this for a few months now, that demand has been overstated. But again, if you look at what's going on in the wet freight market, which correlates very strongly with this story, there's been a shift of DPP VLCC tonnage being cleaned and being put into CPP service. Roughly 7 or 8 VLCCs that I've seen from different sources being cleaned to be put into from dirty product and clean product. And there's a demand for traders to do that. And you ask, why is that happening? That's a lot of freight being transferred. When you think a VLCC carries 2 million barrels of product, and if you've got 8, you're roughly 16 million barrels of gas oil that could easily be loaded out and moved. And a lot of these ships are being booked from Far East to Europe or Far East to West type transit flow. And so it shows that there's an actual excess of product to be exported out. Traders have picked up on it. They're converting freight into clean product freight, which means we're going to see this flow happen. And when you make that investment on a crude oil carrier to convert it to a clean product ship, that's not a small investment. That's a huge investment.
What is the cost on one of those? How much does it cost roughly in the V market so you can load clean instead of historically loading crude? What's the cost?
You think you're going to take the ship out of service to clean it, and that's probably a 6 to 8 week process. It's probably about $1 million, I would think, to clean. I don't have that number. That's a rough estimate in my own head.
Yeah.
That's just for the service to get people into the tank, clean the tank, wash the tank, get rid of the slops. And then you got the time on the vessel. So if the vessel's out of service for 6 weeks at, say, $40,000 a day, that's a fairly large chunk of change you have to cover in order to recoup that cost. And so if you're a vessel owner and you got somebody who's willing to pay that bill, okay, you do it, because currently DPP freight for VLCCs and Suezmaxes are fairly weak. So you do have a large supply of ships with very little cargoes to move. Therefore, freight has collapsed. And this is an outlet for those ships to get off the market. Because when you think, that's roughly 10% of the world VLCC fleet going out of crude transportation into clean product transportation.
Yeah, that's significant. Do you not think it's a little, people jumping on the bandwagon there? I mean, we started talking about OPEC bringing back oil from October, 2 million barrels a day, but slowly bringing them in and phasing them in by sort of Q3 next year, say. With more oil back, these will be in Suezmaxes should strengthen towards the end of the year. Why would everyone be jumping on, okay, right now it makes more sense to go clean? But if you're talking about that's a 2-month process all in all, that's the end of October. That's when OPEC are going to start bringing back oil. So do you not think it's a little early for all this shifting?
I think OPEC's going to bring oil back. And as we said earlier in this podcast, based on the current demand profile that OPEC has degraded to demand, we'll have the IEA oil market report out here, I believe, in about 2 minutes at 10 o'clock Central European time. and they're probably going to show weakening demand. Does OPEC bring crude back? And I think OPEC will not bring crude back. I think OPEC's got to roll the cuts forward still, and they got to delay the return of oil to the markets. Even though they need the money, they need the cash. They don't want to see the market collapse.
Yeah,
And
no,
I think
I
traders who
can't,
are
I
booking these
can't.
ships have already made that call.
Yeah, the other consideration as well that they've got is that, and we touched on this earlier on, US oil production ever increasing. If OPEC do keep oil off, it just invites the US producers to step in to fill that potential void. So there might be a bit of market share protection as well coming in.
Maybe, but nevertheless, a lot of that crude in the U.S. ends up going into Europe, or it ends up, very little on long haul. Well, there's a fair amount on long haul to China as well, but it's just part of the crude mix. And with the TMX pipeline exporting out as well,
Yeah.
that puts extra pressure on the OPEC flow. Um, and so, if OPEC wants to increase market share and they want to flow more oil into the market, you're going to see markets come off. I think we'll get back down to 75, $70 if they start pulling that lever.
Yeah, maybe. I mean, look, holiday season in full swing. The IEA report coming out, like you said, momentarily. I suppose, it all eyes, regardless of what's happening in on the fundamentals and what OPEC may or may not do, what's happening, the closer we get to it, we've got the first presidential debate between Trump and Kamala Harris coming up, I think mid-September. I mean, all focus will shift on what happens in US presidential elections, don't you think? Going over the next few weeks.
Oh yeah, I think that's going to be a lot. That's going to be a big talking point because that's going to drive a lot of what people think is going to happen. Um, sorry to come back on that thought, but the IEA reports coming out. They're lowering their 2024 demand growth by merely 4,000 barrels, but dropping the 2025 demand growth by roughly 20,000 barrels a day. So not much of an adjustment, but still an adjustment lower. But nevertheless, on the election front, yeah, I mean, so you've got the Trump Harris debate coming up. You've got the concerns about what that's going to mean for oil policy. I mean, I've always said that if Trump wins, it's probably bearish oil because he's drill baby drill and try to get some of the things happening again. I think Harris is bullish oil because she'll be limiting oil production on federal lands, what have you.
Yeah.
Probably tougher, stringent emissions regulations as well. So it's a bit of that yin and yang on how the two candidates sit. But it just adds more to the geopolitical risk that covers oil markets in general right now.
Yeah, and then of course we've got our mates at the Fed, what they do. But yeah, look, I mean, just going back to the IEA report there, market's muted, no change at all. 4,000 barrels. They need to get back into OPEC's good books. So perhaps they have got one eye on that, he says, without prejudice, Your Honor. But yeah, look, good to see you. Mid-80s on low mid-80s on Brent. I think we'll probably stay there. If we're gonna have an episode next week.
No, I think next week will be a bit tough because I've traveling myself, but I think the week after that we'll be back full force again.
Yeah, let's do that because that'll be before APEC and all that, and new academic year. But yeah, let's see.
All right, members of the TSP Nation, thank you for tuning in for another episode here. Click like, subscribe,
Yes.
Tell your friends, tell your families if they ever want to hear more about the interesting segments of the oil markets. Tune into the Smoking Barrel. Big shout out to Irene. Thank you again for another good year, Irene, and hopefully see you around more. And everybody take care. Happy trading.
Ciao.